Hi, and welcome to another episode of Nursing Your Way to Wealth, where a mental health nurse and an accountant talk about wealth creation, personal development, and financial independence in the UK to help you live the life you deserve.
Hello and welcome back. This is episode 72 of Nursing Your Way to Wealth. Apologies for the short hiatus that we had last week. I was pretty unwell. I think I had some kind of bug. It's just a symptom of working with the public and lots of kids, I assume. So we're back to kind of usual planning and episodes now. So this is episode 72, which is called Company Statements 2. It's a follow-on from the first one on company statements, where accountant Alex just delved a little bit into kind of financial statements. It would be of use if you were to listen to that one first, because Alex will reference some stuff from that episode as well. That episode is number 69. So just scroll a bit in your podcast player and you'll find it. So if you haven't already listened to episode 69, I would suggest do that before this one. So add it to your queue. Only because it'll make it a little bit easier. So in terms of just the generic intro, I've been listening to another, actually not been listening to this one. I've got it via the Libby app, which is like an e-reader, similar to like Amazon Kindle, but it's run by your local library and it gives you books for free. The book I've been listening to is called The Courage to be Disliked by two Japanese chaps called Koga and Kishimi. I've said chaps, they might be ladies, who knows? Two Japanese people, and it's about thinking about how we perceive and think about events that happen to us. So there's a selfish reason. I'm trying to sort my brain out, so I'm hoping it can help a little bit with something like that. I'm a couple of chapters in. I like it. It's very it's like informative but easy to read. It's done as like an interview between a student and a Greek philosopher. So it kind of blends a little bit in terms of mental health and processing and like Greek philosophy. So they reference stuff like Plato, Seneca, etc. There's a little bit of Stoic stuff in there as well. But Alex, over to you. Have you read the book or no?
Funny you should mention that because I also have got the Libby app and it's really good. And that book is on my I think it's actually might be on my Spotify audiobook playlist to read. So I am I've got one book which I'm listening to at the minute, and after that I'm going to listen to the Courage to be Disliked. I'm actually reading a book on the Stoic path to wealth at the minute. So it's all very
Are you? What's it called?
the Stoic path to wealth.
Oh, is that literally the title?
Yeah. Sorry, that's
Oh,
it.
okay.
um,
Okay.
which is I'm interlinking the Stoic philosophers and controlling your emotions when it comes to investing, which is worth a listen. But yeah, I'm pleased that you mentioned that book and also the Libby app. So anybody that doesn't have it, it's definitely worth subscribing to because they've got books on there and also audiobooks that you can listen to.
Yeah, absolutely. I mean, I'll add that book to my own list as well. So thank you for that. But the interesting thing about the Libby app is you can sign up to more than one library. So within Kent, there are loads of libraries. So I have access to Canterbury, Maidstone, and I think one in Dartford, or some Gravesend or something like that. So I've been able to add more than one local library. I think it's done by county. So you can add like extra kind of stuff in there, and you can actually request books as well. If they don't have it, you can just send a request, and they'll consider getting it in. So I think it's probably worth doing. I would at least check it before you use an Audible credit or you buy like a physical copy of the book. Also, yeah, it's I find it very useful. I've read and listened to a lot of books there. Sometimes you have to wait a little bit for them. There's only so many copies, but I've probably saved myself about 25 Audible credits at this rate.
Yeah, I didn't realize that about using multiple libraries. So I'm gonna have to, because I've just got like the Walton one. But I'm sure there's others in Surrey that I could get to. So yeah, that's good tip. I should look at that.
Yeah, just widen the search area and you'll probably find what you need. Yeah, I didn't realize either until I asked like one of the guys on the help kind of thing. I was like, "Do you have this?" And he was like, "Not in your area, but you can add this one, which have the book." So that's really beneficial. So it sounds legit as well. It's not like you're fumbling it or you're kind of doing something you shouldn't with that. Yeah. Okay, so instead of return on heartbeats, we're going to add two versions of reasonable or ridiculous, because both Alex and I have one for the other person. The only thing I'll mention quickly before we begin the main kind of body of the show is my wife and I went to a local like safari park, and it's called Port Lymph. It's in Kent. It's by a town called Hythe, which is on the southeast coast. It was great. We had an afternoon tea in a really impressive looking kind of like mansion style room, huge ceilings, painted murals, etc. And then we had like a 50-minute safari tour by jeep around the kind of the park, and the chap who was driving has this loudspeaker like connection to the people kind of in the truck, and he's saying like, look left for this rhino, look right for this giraffe, and gives you loads of additional kind of info about the animals. So if you're in Kent, I would highly recommend it. If you haven't already been, if you're not and you're traveling, I absolutely would recommend it as well. So it's Port Lymph National Safari Park, and it's called something else as well. But it's yeah, worth a trip for sure.
Oh, brilliant. No, that sounds really nice. And I didn't realize we had a safari like that in the UK. So brilliant. It's on the list.
Yeah, yeah. Um, yeah, definitely. And if you ever come this way, you can always stay here. And I'll happily go
Oh,
again for sure.
perfect.
Yeah. Okay. Company statements too. Then over to you. This is more your bag. I'll just add some questions in kind of as we go. But unless there's anything else intro wise you want to mention, just fire away.
No, I think that's a good intro, and I'm going to talk a little bit more about so building on the kind of first episode of company statements where we talked about so every company every year has got to produce three kind of statutory financial statements, so like a profit and loss statement, a balance sheet, and a cash flow position. And what I'm going to do this episode, and I'll keep it fairly broad. And I appreciate there's going to be loads of metrics and ratios that I won't talk about, but it's just to kind of give an introduction to some of the key ones that you might hear about if you're reading like the financial press um, or somebody like reviewing financial results of a company, or like if you're looking at or reading about potentially investing into something, these are some of the metrics that might come up. And I'm going to take probably about 15, 20 minutes just to talk through some of these metrics, what they are, how they use the different financial statements, what could be good, what could be bad, what you could look out for. And this is really if you're keen on, I know we are huge proponents of index investing, and the vast majority of my money is in index funds, but I do really enjoy researching companies, and how I've got a few individual shares, and those things aren't going to make me rich. It's the index funds are going to do it, but I do it to get I get a lot of enjoyment out of it. And if you're keen to kind of do a similar thing and start investing in individual companies, it requires a lot of research and a lot of reading. And I hope that at the end of this episode, you'll have a few kind of a bit more of an understanding of some of the key ratios and stuff that get talked about, and that you're going to be looking out for when you're looking at valuing a company. And I guess there's a few ground rules with the like financial analysis. One of them being you can't really take one snapshot or one date in isolation. You need to compare it to multiple periods within that company. So ideally, you're going to be looking back 5 to 10 years of the same company to track performance, and you can see whether certain ratios are improving or if they're declining. And also if you are looking at companies, it's important you can't really compare across sectors. So some are, um, because sectors are quite unique in the way they operate. And if you maybe even look on your investment app, you might have even categorizations of your own investments by what they call like the industry. And it's just purely because if you were to compare like an airline to a brick manufacturer to a consumer goods company to a bank, they're so different in terms of how they operate, and you can't really compare across sectors. But what you can do and what you should do is when you're looking at a company, look at its competitors and look at its sector and how it compares within that. kind of looking at it as in comparison to the total market as well can help, but mainly it's looking at, you know, looking back at historical information for the same company and comparing that against its competitors. And the fundamental principle with investing is you're investing your money, this isn't a stock price that goes up and down on a screen. It's fundamentally an ownership of a company. And you want to make sure that you're handing over your money to a management team in a company that's going to help grow your money on your behalf. And you need to put that in the best place possible. And that's what we're looking at is how well this business is operating and how it's performing and how well managed its balance sheet is and how well it can convert cash because then that's ultimately the cash is yours. You have a share of that cash as an investor. So before I dive into kick off some of the different ratios, um, Alex, do you have any initial questions or thoughts, or are you happy to crack on?
No, I do have a quick question. So,
Yeah, yeah,
in terms of like when you say compare within sectors and you can find some information about this, like an index fund is made up of loads of companies that are within different sectors. So, off the top of my head, you mentioned kind of some of them, but like would financials be an example of a sector like tech or health,
yeah.
commodities, something like that? So broad areas that fit a lot of like companies within them.
Yeah, that exactly. So yeah, nail on the head. So they try and classify them, and I don't know how many there are. They're probably 20, 25 like recognized sectors, and each of those have got a unique batch of companies underneath them which behave in a very similar kind of way. So like mining is a good. So mining is usually grouped together, and so within that you'll have like BP and Shell and like ConocoPhillips and big companies like BHP, Billiton, and then you'll have airlines which will have International Airlines Group and EasyJet and Ryanair. Um, and it's just being mindful of not comparing, especially when we look at like valuation ratios or like gross profit margins, things like that. They're going to be very different sector to sector.
Yeah, I suppose even within that, if you dig a little bit into it, so one of the sectors could be, for example, travel. That could um, that could cover like airlines. It could also cover like ships or like um, not like commercial shipping, but like cruises, holidays. I don't know. Is residential shipping a thing? Just not like freight stuff. So, like you're comparing the say the travel sector, for example, you wouldn't compare an EasyJet airline with a company that does like cruises around the Med or something because they're kind of different things within the travel sector.
Yeah, and exactly. And I think this looking at a company's competitors is usually because they'll usually have three or four competitors, and they're normally
Mm-hmm.
referenced in their annual report at the but towards the back. There's usually like a um like competitive environment, or they talk about the risks to the company, and usually in there they will mention their biggest competitors, and and even well Google will have it as well, so you'll be able to see who these companies compete with, and it's probably that bucket of companies that are most relevant to you because if you want to be yeah if you're really keen on you want to buy into an airline because you think airline you know is going to keep growing and there's a good market for it, you'll probably want to look at, well, if I'm the things available to you, the investments to you are probably like, within the UK, you've got IAG, so that's like British Airways, Iberia, like that group. EasyJet is the other one. I think
Mm-hmm.
Ryanair is the other one. Um, if you're looking to Europe, I don't know if Wizz Air is on the stock market, but you then look to compare those. You probably look at those. You wouldn't then, yeah, as you said, compare British Airways to Carnival Cruises, even though they kind of operate broadly within a travel sector. Or you wouldn't compare like Carnival Cruises to a hotel business, for instance. So it's just been, I guess, comparing close enough within the sector that you can make reasonable comparisons and a good judgment.
Yeah, it makes sense. Just for clarity, if you could hear me typing, then I was googling is Wizz Air listed on the stock exchange?
Ah,
It is, and as of today, it's down 0.15%. So
oh,
yeah,
unchanged.
yeah. I mean that said, well, it's down 8% in the past year, or 60.96% in the last 5 years. So your mileage may vary, literally
Mm,
and monetarily, with something like that. So I mean, 60% down is not great, but if you think about if you can find something that's 60% up, that's a different story. So I mean, funnily enough, within the last 5 years, it's 60% down from the maximum point. Just from this, it was initially listed what looks like early 2015. And now in August 2025, it's averaged plus 1.68% in that time frame.
what per year? Or would that be the total?
And well, it just says all time it's
Oh,
gone
wow.
up by it's
Okay.
averaged out to be up by 1.68%. So
Oh, fine. Not a good
wouldn't have been
investment.
ideal.
No.
No, at that point. I mean, that said, if you bought them early 2015, each price was it was 1,310 points, I imagine. You could have sold it at the peak for nearly 5,000, for 5,500. So you could, if you timed it well. But then we've talked about market timing and how difficult that is.
That's it. Yeah. It,
Yeah.
and I think this is where, yeah, individual company buying is very risky and definitely not the. I think if you can pick, good companies that are solid, and this is hopefully some of these ratios might prove why Wizz Air may not have performed as well. I also imagine with airlines, obviously COVID happened during the middle of everything, which crashed it all down. But I know IAG has come back and doing very well. But yeah, awesome. So with that, let me start talking through some of the key ratios that you might want to look at and when evaluating a business. So the first kind of set of ratios are all to do with profitability. And so this is where this uses the profit and loss statement to determine how effective and how profitable a business is. And so there's a couple on here, they're like gross profit margin, and that's seen as a percentage. So you might sometimes hear, you know, this company's gross profit margin is 30% or 50% or about 65% in the case of Nvidia. So that's taking essentially the cost of all your revenue. So it's the cost of making your sales. So it's your gross profit divided by your revenue. Um, that doesn't include any headcount costs or any cost to like have your office or marketing or R&D or anything like that. That's purely I buy these things for £1 and I sell them £5. Um, and that'd be the difference would be your profit and then your gross profit margin. There is also then an operating profit margin. So this is as you work your way down the profit and loss account, you see operating profit, sometimes called like earnings before interest, tax, depreciation, and amortization, or EBITDA. It's also called like cash profit sometimes. But that's how once you kind of take into account all of your like operating costs, how profitable that business is. And with both of those, you want to be seeing a healthy profit margin. You ideally are, 30, 40 plus percent gross profit and as high as possible on the operating profit as a margin. And this is where software companies um, are so profitable is because once it doesn't cost them much to sell a product or a subscription. So they've got incredibly high gross profit margins. Whereas if you are um, an outsourced company that you know sends be like in our office we have like the cleaning staff or the food company, the food outsourced food company that like looks after the canteen. They're incredibly low margin businesses, um, and you want to see that profit margin growing over time, so the company's getting more efficient at making money. See, earnings per share as well is I think we talked about this, but it's a key metric on one to look out for. So earnings per share tries to distill down what the earnings and then what the profit attributable to your shareholders is for every share that's an issue. And there's some valuation metrics, which I'll come to later, which uses that earnings per share. And then as a combination of a metric, you might hear like return on capital employed or ROCE, sometimes it's called ROCE. So return on capital employed. This is a really important metric and it's a big determinant of how successful a company is in the long term. And all this is doing is taking the kind of the operating profit of a company and or your EBITDA and how is what's that return as a percentage of all of the capital that employs. So by capital, that is all the shares that it has in issue and also the amount of debt that it's got in issue. So for the value of all that, so say if you've got a capital base of 100 million and you've made profits of 10 million, that's a 10% return on capital. And you want that, and the way to almost look at that is saying, well, you're giving your own money as an investor to a company, and that's the return it's going to make for you. And you want to kind of determine if, say, in this case, 10%, or it could be the 5-year average is 12%. Are you happy that the company is going to continue generating 12% a year with your money based on, you know, its current performance? And that's a really key metric, and you'll see that on like Yahoo Finance quite a lot. But it's the value of all of the equity and the debt that it has in the business and how profitable it is on that.
Can I just ask a question about that bit specifically?
Yeah, yeah,
I
please.
might be wrong because I don't know anywhere near as much as you do on this kind of area. But for example, if you're say you're looking at a particular company and you mentioned this return on capital employed, if you see, for example, it's constantly going up, but also they're seeking loads of rounds of investment. They're really pushing like invest in this, blah 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 blah. Could it be that that company is only surviving because there's loads of new money coming in rather than it making money itself? Like, how would you differentiate that, or how would you figure that out?
Yes. So I guess it's so companies are yeah, so they need, and this is probably more of an issue for kind of early stage companies where they're not that profitable and they
Mm-hmm.
need to um, essentially have lots of capital, lots of equity or debt to invest in themselves to have future profit. But essentially, a company, as long as it has enough money, can continue operating. It doesn't have to be profitable. Um, if you look, Amazon is probably a really good example of this. So when Amazon first started, probably even within about 10, 15 years of Amazon operating, it hadn't turned a profit. And so they would sell shares in the company to outsiders that they listed on the stock market. And the reason that they didn't, so they had the cash, but they didn't make it much profit because they were investing so much in assets and R&D. And now it's starting to pay dividends in terms of they're incredibly profitable. So I guess you can still continue operate, and this is where with like I guess looking at metrics, having them in a standalone is a bit dangerous. You've got to look at it over time. So if you were to look at Amazon's return on capital employed, it would probably be quite low at the beginning because there's so much capital going in and it's not making any money. But over time, when you look at historically, then you're almost trying to get to like if you imagine like a graph, it goes it'll be quite a steep curve up with your return on capital employed. So it will start to improve. And then over time that's where yeah, you'll see the return. But it's context of the company is important as well.
That's it's interesting. Yeah, I'm looking at the Amazon the kind of stock price over the maximum amount of time I can
Hmm.
currently, and it started in '97. And really, the line is flat all the way until just after
Yeah.
2009, as it kind of lifts itself off the floor. And in fact, actually, 2007, there's kind of some daylight at the bottom of this graph. And then it goes from there and it only moves a tiny, tiny bit until really 2011 ish. And then it starts moving upwards slightly. And then there's huge leaps after about
Mm.
mid 2017. It starts pointing up and to the right. And then there's kind of a dip in 18 and then all the way up. And it's kind of going ever since. But over time, it's gone up 245,000%.
Yes.
So it's 245,944. So nearly 246,000%. If we compare that to Wizz Air, that's a humongous difference.
Yeah, absolutely. Yeah.
I mean, obviously, different sectors, etc., like you said, going for different lengths of time. But I think this is why people take punts on new companies, isn't it? Because they want the outlier that the kind of 100x's or 1000x in this case.
Yes, exactly right. But yeah, when you look at early stage companies or very high growth companies, which need a lot of investment, some of these ratios will look quite poor. So more established companies, like if you were to look at P&G or Unilever, their current kind of profitability, return on capital employed will be very stable, and you'll have a lot of you'd be very confident as an investor that that company will continue going and generating those type of returns. What's hard and where the big money is, it's the, the something like the tech boom and Amazon is a great example. Like, yes, that you will look at it won't be profitable. They're investing loads of money. They're a huge cash drain. And the promise of those returns was, 10, 15 years in the making. And but the person that invested money in Amazon also would have invested in a bunch of other companies at very early stage, high tech, high risk. Um, and so it's a really good point. It is really interesting, and it's where that company lies within its kind of maturity cycle. But yeah, not all of these ratios will be universally applicable.
Yeah, it's interesting, isn't it? How you look at it, like according to this graph, which is just freely available on like Google, basically here, it took nearly it to get to over $10 per share. That was kind of my mouse pointer's not that great here, but in July 2011, it went just over $10 per share, and it began in 1997. So it took that long to get to $10 per share. That's not like humongous growth for a huge amount of time. And now it's $221 per share. So if you buy it at 10 or less than one, you're making insane amounts of money. It's just taken 30 years or a bit
That's it.
less,
Yeah.
15 years, 20 years, something like that. Yeah. Sorry to distract you. I'm
No,
just
no, not at all. It's a
thought it
good,
was useful.
yeah. And we may have to straddle this episode over a couple of episodes. But the next, so those are like the profitability ratios, which you will see are kind of quite important. The next bit is looking at the balance sheet. And for most company, where balance sheets get really confusing are banks and insurance companies. I wouldn't suggest looking at some of those if you're just starting out with these. But what you want to look at with your balance sheet, so your balance sheet is looking at essentially how much money a company's got, and it's the long-term scorecard of the company. So I was always taught for me like the profit and loss is your if you imagine the metaphor of the Premier League football season, the individual match that you have is your profit and loss account. So it's 1 year, it's you know limited to that year. Your balance sheet is the Premier League table and where you sit in that Premier League table. So it's the consolidation of all of those years and all of those matches is where you end up. And again, different businesses are financed in different ways. And when I talk about financing, so your balance sheet looks at everything that you own, sorry, as a company, or your assets. Things like it could be stock, it could be some intangible assets like patents or like research that you've done. It could be cash, it could be inventory, your receivables that you are owed from companies, and then also what you owe out. So you'll have companies quite often have debts, so either bank loans or they will have corporate bonds that they've issued, and also payables for its suppliers. And then the difference between all of those assets and all your liabilities is your equity, and that's the shareholders' funds that is essentially you as a shareholder own. And there's a couple of the main metrics that you look at on your balance sheet is mainly to do with your ratio of debt to equity. So you're going to have on the balance sheet you'll have long-term and short-term funding. So this would be debts, the bank loans or the corporate bonds, and you'll also have equities, your shareholders' funds, and you don't want and you'll have a ratio between the two. So you can either look at what they call gearing, so it's debt as a percentage of both your debt and equity. And just for simple numbers, if you had $50 worth of debt and $50 worth of equity, so that's a 1-to-1 of debt to equity ratio. And as your gearing percentage, you've got $50 of debt divided by $100 of total capital, so $50 of debt, $50 of equity. So you'd have 50% gearing or leverage. And those are I guess, two main things to look at on the balance sheet. Also, it's good to look at how much cash the company's got. So you want to have cash, but you don't want too much cash. And there's a thing called working capital. So this is where you take your kind of assets, your like current assets and your current liabilities that you'll find on your balance sheet, and that will show you how much working capital that you've got tied up in that business, and you want that as low as possible. The other ratios that you might see on the balance sheet is called like current ratio. So that's how many dollars or how many pounds of current assets do you have? So those are things that are owed to you within a year, divided by your current liabilities. So how much do you owe out within that year? With the view being if you had to just sell everything now to pay off the things that are due within a year, do you have more assets than you do liabilities? And you want to have companies which are got a ratio of that about above 1, so that they can cover their short-term debt. So those are the main things around the balance sheet that you'd look at. And again, it's trying to get an indication about by using like the annual report, you'll get an indication of where the business is performing and the stage in its life cycle, and also looking back at historic periods of gearing. Because you might see that they've borrowed a load of money, but the company might have just bought one of their competitors or bought another company and borrowed money to do that. Or if they're a company if you're an airline, they may have just borrowed a load of money to buy a whole set of new planes. So on the face of it, it looks like but then they might have a really clear plan of paying that back over, 3 or 4 years. So it's using ratios within context, looking at historic trends and looking at those like looking at the competitors. But you don't want to be having companies with debt. I've always been taught like anything above 50% of gearing is high. So you want to have companies which are kind of, so debt can be quite good for a business. It helps it grow quicker than if you to set equity. But you don't want too much debt. And often within the annual report, the chief financial officer will talk about like funding levels as to what they're comfortable with. And this does vary sector by sector. But yeah, too much debt, especially on a business that's not very profitable, is a way that you can is a sure way to lose money in the long term.
Yeah, so it's like the way when you speak about these particular things and how stuff is balanced, it makes me think about like a seesaw, but not
Mm-hmm.
just a seesaw like with two ends. It's probably got like at least like a seesaw is like a cross shape, or you'd have like three seesaws all going at once, but they're all joined together, and movements on one side impact the other, and they all move independently. And it's kind of thinking about yes, something might look a certain way, but why Does it look a certain way? What context is there around that? And for example, would you say, let's use an airline example, for example, planes cost many millions of pounds. So you look at a company and you're like, actually, they've got debts of, I don't know, 200 million quid. And it might be that because they've just bought, well, I have no idea how much planes cost, but they might have just bought 2 planes or 10 planes or something. Could you then find that information out? Like, would it be on like a news story, or would it be, could you find it or like ratify it somehow? Or is it like you speak to someone who knows a guy who knows a guy who works at the airport and they're like, actually, there's loads of planes here?
Yeah. So that's a really good question. So if there is a large amount of, if the debt has increased markedly, like over time or over like period over period, they will usually talk about that in either the annual report or there'll be news articles about it
Okay.
because it will be something that um, will be um, pertinent to shareholders. And you, and also along with that, they do, they will talk about, we bought X new planes, but we expect it to generate X amount of cash once they're fully, up and running or
Mm.
operational or what have you. And they will give guidance on that. So, like a good example, so I have shares in a company called Safe Store, who are, it's the UK's biggest like self-storage center, and
Yeah,
you
there's
can
one
see
near
them.
me. I've heard of it.
Yeah, yeah, they'll be dotted around everywhere.
Yeah.
So they're a bit like under the radar in a way, in that they just sit on the side of motorways or in crowded areas, and people just stock like shove their old stuff in there. But they've been buying up companies in Europe because Europe's very underpenetrated. But they say that we've borrowed more money because we bought um, these companies in Belgium to secure a presence in Belgium, and that is going to mean once they're renovated and up to scratch, will lead to X million pounds a year of extra revenue, and then we will like pay down our debts of the like 5 year period to like make it like value accretive to shareholders. So it's a very like quite clear plan on what they're doing and why. But if you looked at just the ratio and think, oh wow, like their debt's gone up massively, like what are they doing? And it's one of those things that their debt's gone up, but their profits haven't really followed. But it will start to flow through over the kind of 2 to 3 year time horizon, and then they've got foothold in new markets. So it's combining some of the like almost raw data that you would see and some of these ratios with the story of what the business is doing.
Right. Okay. I mean, those are expectations, right? Isn't it? So, firstly, huge caveat here. Just because Alex has said he owns this, we're not suggesting you buy it.
No, no, definitely, yeah, yeah.
Secondly,
Thank you, Alex.
there's
Thanks.
a plan for that, isn't there? So actually, they're going to be like, actually, we need to buy some more stuff in a country that we're not currently in to help grow the business. So we'll borrow this much. We'll buy loads of, I don't know, companies that do the same thing, or storage places or land or whatever. I don't know. And then the plan is, yeah, we've borrowed, I don't know, 10 million quid to buy these things. So it looks a bit rough right now, but over the next 5 years, we're expecting to pay that off, and then we'll have an extra £2 million worth of ongoing yearly revenue or something. So it could look like people who make these decisions, they don't drop that much money on like a whim, do they? Hopefully, so there's a plan for that to work. The potential is maybe that doesn't work, and they kind of have to either resell what they've bought or pivot into a different place. If the company's big enough, they might just, I don't know, write it off as a loss, and can swallow something like that. But if it can't, and it's on like the breadline of is it going to survive, is it not, and it has to kind of swallow a 5 million quid loss, that potentially, am I right in thinking that could put that company into bankruptcy, and then maybe it's 50-50 whether you get your money out?
Yeah, in an extreme situation, and I guess this is where, so, and also on the other side of that transaction, there are usually banks and also debt investors. So they will also be looking at the plans for that company, and it's they would never, like a bank wouldn't lend to a company if it didn't think it would ever get its money back. But there
Okay.
are certain things. So and this is self-storage is probably not the best example for something like this, but if you're say um, like medical research or you've got a drug, if you're a pharmaceutical company and quite early
Mhm.
stage pharmaceutical company and you're doing some research and you borrow loads of money on the hope that you're going to get this drug approved, and then suddenly the drug doesn't get approved, and there doesn't look to be a hope that it will ever get approved, you've racked up loads of debt with no way of ever getting income, and then potentially lots of debts to pay off. So
That's a
that's a
problem.
much riskier, yeah. So it's in those type of industries where like one decision might like make or break the company. But certainly these like big footsie companies, there's a huge amount of governance that goes on within them before decisions are made, and they're very unlikely to have one like buying something quite small in proportion to the overall company risk like bringing down the entire thing. Um, I'm trying to think what usually where things like this get out of hand is in big like mergers or acquisitions, and it's where companies will load up on debt because they can buy a competitor, and there's a lot of hubris in boardrooms and a lot of egos on boards, and often you overpay for a company. The integration doesn't work because the cultures are so different. Um, I'm trying to think off the top of my head where one of those things, but nothing springs to mind. I'll try and find one for the next episode. But this is
Yeah,
where then,
you can see how that would happen though, wouldn't you? Like a boardroom. I've never been in a boardroom, full disclosure at all. I probably never ever will be, but you can see how it would be like, oh, my company's bigger, I can afford this, and we can do that, and I'll happily pay way more than's needed just to show you how big my bollocks are. Excuse my
oh yeah,
language, but
oh there's a load
ha-
of a lot of dick swinging in a boardroom.
yeah, exactly. Happens an awful lot. So if you over leverage yourself, it's like you taking out like too much of a loan somewhere and then not being able to back that up. Like
Yeah.
at some point, it's gonna bite you. So it's an interesting thing that I wonder how many negative or bad decisions are made when people are either hungry or jealous
Mm.
or tired or under caffeinated or etc. They're just kind of not thinking with the analytical part of their brain.
Yeah.
Um, and then, yeah, it's. I wonder if there's a book on that because I feel like that would be useful to know. Just examples of where that's happened. Maybe I don't know. I'll look that up in the meantime in the week.
Yeah. So I think there's some really good there'll be loads of examples of where these things haven't worked. And I think this is where like if you are looking to invest, it's making sure you've got a company that's got a really solid balance sheet and that is like financially very stable.
Fundamentals.
Fundamental, yeah, and it is just and it's like, do you have basically have you got the money in the bank and to support your company um over the long term, and you're
Yeah,
not abusing that. Um, and if you are, taking on more debt, does it is your balance sheet, are you well funded in order to be able to do that? Have you got enough headroom, or are you suddenly going to become incredibly risky because you've suddenly got loads of debt? Because it has a huge knock on other metrics and different returns that investors want as well when you've got too much debt as a company. Um, so it is a fine balance, and there isn't a
yeah.
kind of perfect answer.
No, and we're back to like human emotions, aren't we, of changing things. Like,
Yeah,
for example, if loads of people invest in this particular kind of storage company, they realize that actually, I don't know, something in the environment is going on. That means people aren't using them anymore. And then all of a sudden they've got, I don't know, a 10% drop in income per month, per year or something. They then might think, oh, actually, we need to move into another country really quickly in order to recoup this loss. And it's kind of very fluid. It's very dynamic. And if you are considering something like this, investing in single stocks, we would always suggest like don't put in any money you can't afford to lose as well. I don't know, Alex, if you would agree. That's just something I've said out loud.
yeah, no, definitely. I mean, the way I run my like portfolio, I guess I've got my like core of my investments, which are all they're big index funds, and I don't have
Mm-hmm.
individual stocks in there. And then I have like this satellite. So this is like, and it's about literally 5% of my overall portfolio. So it has it generates a return, and I get dividends from it, and I enjoy researching the companies. But I'm not reliant on all of those because you can't, it takes a lot of time, and I don't have all of the time to have, 90% of my money in these things. So yeah, be comfortable losing that. That's not the money that's going to get you well off. What it does do is give you a really good understanding of what it's to be like as a shareholder and an investor and an owner of a company. Like that's one thing you don't get with index funds. They're a little bit more volatile generally, but
Yeah.
you'll hear about you'll read their trading statements. You'll get invites to the AGM. You're able to vote in the AGM, the annual general meeting, and it's the way I like it. It's good experience of being an owner of a company, although I own a fraction of a percent in all of my ones. So I do it for that. But yeah, they're not nowhere they're going to almost change the outcome of my financial.
No, like you do a bit of it because you love it, but also there's the
Exactly, yeah.
potential that it could like 100x, etc., or something like that. But I
Yeah.
think there's another bit here about people who work for certain companies having all of their investments in that one company because look, I work here and it's going well and I'm busy,
Mm,
therefore it must go up. I would advise extreme caution with something like that.
yeah.
I listened to a podcast the other day from Meaningful Money, Pete Matthew and Roger Weeks. They mentioned something about like a listener question or something that they were covering about a chap who owned loads of money in a particular stock, and it was passed on to a spouse after he died, I think, and it was worth something like 200 and something K at the point when he passed away. But then when the other person comes to cash it in, it's worth like 30 grand. It's
Yeah.
crazy amounts. Like we'd always say, like don't bet the farm. Keep
Yeah.
most of your money, like indexes, etc. Just index and chill. But when you get into the like almost the Wall Street bets avenue area where people are making ridiculous punts and people only talk about the good bits of that, like the bits where they've
Yeah.
done really well. They don't talk about the downside, perhaps, as much because it's not an exciting story. But yeah, I mean, tread with caution. But if you did want to do something like this, you can use the stuff that Alex has mentioned today and the other episode 69 as well. Alex, is there anything more in terms of ratios we need to mention? Because I've just jumped in, haven't I? Talked again.
Yeah, there's quite a few more actually just on like specific valuation and investment ratios. So maybe we do that as a different episode, as a more
Yeah, yeah,
almost
we'll
as a
do company
continuation.
statements 3.
Yeah, because I think there's a bit more on cash flow and then on valuation. Because I think
Okay.
it's been a really good debate actually, and I'm so glad that you're like some of these the questions are really good, and I think it opens up a lot of opens up real world questions that come up when you're looking at things. So I think if we
Mm.
park the kind of cash flow and valuation stuff for next week on the next
Sure.
episode, we can then wrap up there because you're conscious of the the episode time. We could probably go on for about 4 hours talking about this.
Yeah, maybe. And I think in terms of the questioning from my point of view, this is something that I know very little about. So I've been taking some notes about stuff that you've said, and I'm like, oh, does that link to this? And then I'll ask you, and you'll be like either yes or no, and etc. So I think it's useful. I feel like I'm learning a lot from your expertise in kind of this area because it's just something that I've got no knowledge of. Like maybe we do one episode one day about the inner workings of the liver or the kidneys,
Yeah,
but
yeah, because I'll be
yeah,
I'll be
oh,
completely the opposite. I'll have no
not
idea
sure
about
how
that.
helpful that is in terms of a financial kind of podcast here,
No,
but maybe yeah. If you want to hear about more about the liver and the kidneys or any other organ exactly, just email us and I'll do a bit on each of them maybe.
yeah,
Okay, so
guest pod.
yeah, that's it. That's it. Yeah, so in terms of that, let's park it and we'll come back and do company statements 3 next week. The only other things we have to do, we'll do a quick reasonable or ridiculous each, one for you and one for me, and then I'll do probably the world's quickest summary. Um, so do you want to go first for your reasonable or ridiculous?
Reasonable or ridiculous?
Yeah, I will go first. So this is my reasonable or ridiculous. So is it reasonable or ridiculous to have upgraded my shaving routine? So I bought a nice um, new shaving cream, and I also got one of those badger brushes and a pot, so you're able to like have a real old school style shave. Um, I just thought I'm 36 now, and I think I quite like the idea of trying to take a little bit more care of myself. I have a decent razor as it is, and I just ran out of shaving foam. I thought I'm going to try a nice one. It's from a a shop that was founded in central London in the mid 1800s, and it's got it's had 5 royal warrants, and the shaving cream was just over 20. It's 21 quid, I think. Quite a lot for shaving cream, but I figured that combined with my badger hairbrush, which was £15, offers a nice luxury every kind of maybe once or twice a week when I do have a shave. So I imagine this is like a year's worth of
Yeah.
shaving cream to put it out there. So that is my it was a bit of an impulse buy, and I just figure I felt it was reasonable, hence why I bought it. But I'd love to get your view.
Yeah. Okay. Firstly, I have one side question. The razor you say you have, what
Yeah,
type of razor is it? Is it a cartridge one or is it a double-edged one or single?
it's a cartridge one.
Ah, okay. So I think it's reasonable entirely. Like £21 and 15, like combined together is what 30,
32.
six? Yeah, right. Conveniently adds up to how old you are, but
Yeah, I just figured.
at the same
Yeah,
time, it's not going to break the bank. Like you're not choosing between buying these things or eating for the weekend. So I would say
yeah,
it's reasonable. So long as the shaving cream is it smells nice, it's nice to use, it doesn't irritate your skin.
yeah.
I would say it's entirely a reasonable thing. I've
Sandalwood is
Yeah.
the
So I
scent,
have
so it's
one. I
very
have
very
one of those
pleasant.
myself, like a shaving soap with a
Ah,
brush. It's not Badger, but um, I got a synthetic version of a little like a whisking brush
yeah,
myself.
yeah,
This was
that's it.
about 18 months ago or so. So I bought a double-edged razor from a company that says they're like it's like pirate based. I think I bought one that's called the Nautilus or something. I don't know. It's black, and I found it's really helpful for not giving me ingrown hairs on my neck because it's a
Ah,
single
okay,
single blade, but both sides. So it's known as a DE or double edged razor. If you haven't got one of those, I would suggest one.
okay,
I've found it super nice to use with a bit of practice, and I don't get any ingrowing hairs anymore when I
good
do
to
use
know.
it. And I'm fully on board with that. So I've got all the same similar kit to you, except the Badger brush.
Yeah,
Yeah, so it's
awesome.
100% reasonable. Yeah.
Thank you.
Um, no, you're welcome. Let me know how it goes, and when you get a DE razor as well, that would be good.
Yeah,
So my kind of reasonable or ridiculous. So yours, I think, is entirely reasonable, right? So long as you're not buying like £400 shaving soap or whatever,
no,
even if that exists, who knows?
yeah,
From my point of view, quality shoes. Is it? So I bought two pairs of shoes today. Um, I tried a pair on this morning, and I want to know: is it reasonable or ridiculous to spend quite a lot of money on shoes? So the it's like boat shoes I tried on this morning. It's kind of a cross between a boat shoe and a loafer. They were £175 from a company called Russell and Bromley.
yeah,
They felt great, they looked great, etc., etc. Um, so I didn't end up buying those because she wasn't sure whether they could be resold or not. So I ended up going to an outlet store for the shoe company Loke, which is in Ashford. It's fairly close to me, and I bought two pairs of shoes this afternoon, totaling it's £230. One pair of loafers, which can be resold, and one pair of boat shoes or casual shoes that can't. So my thinking here is buy them once, look after them, and have them for many years. And if one of them, the loafers, do need resoling, then I can have them resold. Um, do you think it's reasonable, or should I just buy like 40 quid pair from Clark's and just wear them for as long as they last and just repeat?
I'm a big proponent of buying quality on
Mm.
shoes, and I think that's completely reasonable. And I have my own. I think the way I like to think of things, like if you look at the cost per year that you would have it, or the cost per wear, and so I,
Yes.
I actually bought as I was doing my accountancy training. So every year, I'd do like basically one level a year, and every year
Hmm.
I would treat myself to something. And in my second year, so this would have been 2014, so 10 years ago, 11 years ago, I bought myself a pair of Church's shoes. So the
Hmm.
Church's Oxford, no, it's a Churchwood semi-brogue shoe.
Okay.
Absolutely love them, and I still wear them, albeit not as regularly. But I've had them resold a couple of times, and they cost me. I think I remember paying £240 for those,
Mm.
and I was and I still wear them, and I see that as being, £24 a year for that same pair of shoes. And yeah, 100% think you've done the right thing there. And the other thing is because they're timeless and they're very versatile, you can wear them on loads of different occasions. They're going to be really comfortable and they're never going to go out of fashion. So when you're in your 60s, you could still wear your kind of loafers and they'll be still as fashionable then as they are now. So completely on board, enthusiastically on board with that.
Yeah, you think it's reasonable, right? So, but that was my thinking as well. So I've just done a quick bit of, well, I haven't done any maths, right? I've gone to the website in 2013 dollars. So £240 in 2014 is the equivalent to £343 38 today.
Mm.
But actually, you've had them that long. You've worn them, I imagine, loads. You've had them resold. So you've got a good amount of value out of it.
Yeah.
And for example, if we then say you buy, I don't know, I'd say a £40 pair of shoes every 2 years, would you say that's reasonable? It would be, you'd have to times that by 5.5. That would cost you about a similar amount anyway, and you'd have had to go out and buy them kind of five or so pairs of shoes in between. So I hope it's reasonable. Like they're both exceedingly comfortable. I've tried on loads of shoes today, and they felt the most comfortable. Like I went to like Clark's and Dykman's and some other department stores, and I went also to what's the other name of the sort of like a popular shoe store? I can't remember it anyway. And I went into this kind of Loke thing, and not only were the staff really helpful, which helps obviously, but he actually explained to me how shoes should fit, and he measured my feet. And like from my point of view, I've been a size 8 since I've been about 14 or whatever. And he said, actually, no, you're a 7. And I was like, oh.
Oh wow.
And this morning I tried on some pairs 8, like some pairs of shoes that were size 8, and I was like, they kind of don't fit that well. And I was like, and she was like, "Oh, well, okay. Are you sure that's your size?" And I was like, "Yeah." And he actually measured me with this elongated roller thing with some metal bits on it to fit it. And he was like, "Actually, you'd fit between a 7 and 7.5. You're annoyingly in between, and this is difference between UK and European measuring, something like that." And I tried a pair of 7s, and I was like, "Actually, these fit really well." And I was like, "Oh, maybe I've just been buying shoes that are too big." But I've got trainers that fit me very well in an 8. So it's, I
The
think it's,
mystery of shoe sizing, isn't it?
yeah, and try before you buy. I mean, really, this came about because I bought a second-hand pair of loafers off the Vinted app, and it was 30 something, 35 or £34, I don't know. And I got them, and I was super excited to get them. I put them on, they instantly fell off because there's so much space behind my heel and the back of the heel of the shoe. So just total waste. So I can't return them now because you can't return stuff because it's the wrong size. So I'm going to have to resell or, I don't know, swallow the cost. So I just thought actually go and try them on, buy them new, look after them. Oh, I'm glad you agree because I also agree.
Yes, I'm
Yeah, in
wholeheartedly
terms
behind
of
that.
shoes as well. My dad's had loads of shoes like that for a long, long time as well. He was very much like polish them on a Sunday, etc. type thing. Okay, shall I do a quick summary?
Yes, but I think if we
Super
summarize,
quick.
yeah, perfect.
Yeah. Okay, so we've talked about, both Alex and I are going to read the book, The Courage to be Disliked by Koga and Kishibe. I've been on a local safari. It was great. I would recommend it. The main summary on company statements 2, we talked about when you're going to compare companies, compare within the same sector. Don't compare a mining company with a perfume company or something like that. Think about the last 10 years, 5 to 10 years of performance. You should think about the profit and loss being short term, like one football game as a result, and then compare that with the balance sheet, which is a long term, which would be like the league table at the end of the season. So one's a short thing, one is a long thing, both thinking about how much money they have or how much money they make. We talked about gross profit margin percentages being a figure of what they buy something for to then what they sell something for. We talked about operating profit margin, which is the reality of how much money do they actually make after they take into account their costs. We talked about earnings per share and how much each share has been worth to a shareholder, which could be you, could be me. We also talked about return on capital employed is a good indicator of a company's long-term success, which takes into account shares and debts. And you can get a 5-year average of those to give a good balance of it. The last thing we talked about was debt versus equity, which is called gearing, and anything above 50% is generally considered to be too high. We've mentioned many other companies. We're not suggesting that you buy them. We're suggesting it's something that one of us has bought. It's our own decision. We're definitely not telling you to do that. And last bit of the summary is we both think that quality shaving equipment for men is a good thing, and also ditto quality shoes. Alex, is there anything else you'd like to mention?
That was a perfect summary. I think you captured everything. But yeah.
Oh, I've written a lot of notes.
But yeah,
so many.
And yeah, if anybody's got any questions, please feel free to reach out to us, and yeah, happy to answer any questions.
Absolutely. We'll come back next week for company statements part 2. The week following that, I'm actually on holiday, so there'll be another short hiatus. Sorry. And actually, if you've got any thoughts about quality shoes or particular shaving equipment for men that you think we'd like to know about, of course, you can send those in as well. Our email address is nursingyourwaytowealth@gmail.com. And with that, Alex, thank you for your time, and we'll see you next week.
Yeah, thank you, everyone. Thanks, Alex.
None of what we discuss on the show is to be considered financial or health advice, and we recommend you always do your own research or consult an independent financial advisor or a doctor when making your financial or health decisions.